So, when you look at the landscape of American financial institutions, the ones that trace their lineage way back to the founding of the country.
Right, the real legacy players.
Exactly. They usually behave with this very specific, almost, glacial kind of predictability.
Yeah, you can definitely expect them to move slowly.
Right. I mean, you expect an institution founded in 1784, literally chartered by Alexander Hamilton, to just be this unmoving bedrock of the financial system.
You expect a massive, incredibly stable balance sheet.
Yeah, and a reliable, if maybe a little slow-growing dividend.
For sure.
What you absolutely do not expect is for it to suddenly start throwing up the kind of explosive, tech-enabled growth metrics that you'd normally associate with, like a Silicon Valley software startup operating out of somebody's garage.
No, not at all. But I mean, that is exactly the paradox we're looking at today.
It's wild. And it totally upends the traditional banking narrative, right?
It completely upends the narrative that we've all basically been taught to accept. For decades, the assumption on Wall Street has just been entirely binary.
Meaning you're either one thing or the other.
Exactly. You are either a mature, highly regulated value play that grows at the speed of the overall GDP.
Right, slowly.
Right. Or you're a hyper-growth tech disruptor just burning through cash to acquire market share.
There usually isn't an in-between.
Exactly. So seeing a custody bank with centuries of legacy infrastructure operating with this level of agility, it's a structural corporate transformation happening right in plain sight.
Which is exactly why we're pulling out the magnifying glass today on Talk Tickers. Welcome, by the way. Today we are taking a deep dive into the massive and frankly incredibly dense Q2 2026 earnings call transcript from BNY Mellon.
And it is dense.
Oh, totally. Our mission here is to extract the hard data, translate all that corporate jargon and the analyst Q&A sessions into plain, actionable English, and give you an opinionated bottom line in under 5 minutes.
Because if you're holding this stock in your portfolio, or even if you're just considering allocating capital to it.
Or just trying to understand the global financial plumbing, really.
Yeah, exactly. If you want to know where the global financial plumbing is headed over the next decade, this data is critical.
So we need to start by just looking at the sheer scale of the baseline they just established, because the Q2 headline numbers are just staggering.
They really are. I mean, where do you even want to start?
Let's hit the top line. Total revenue hit a record $5.7 billion.
Wow.
Yeah, which is a 13% increase year over year. And I mean, for a custody bank of this massive size, a 13% top-line expansion feels, almost anomalous.
It is anomalous. And to understand why it's so weird, you have to look at how custody banks traditionally generate their revenue.
Right, break that down for us.
So unlike a commercial lender that can just rapidly expand its top line by aggressively underwriting a bunch of new loans.
Which obviously introduces a massive amount of credit risk.
Exactly. A custody bank doesn't do that. They rely primarily on fee revenue derived from asset servicing, clearing, and, trust services.
Okay, so it's fee-based.
Right. Their revenue is usually highly correlated to global market valuations and just overall transaction volumes.
So if the market's up, they're up.
Generally, yes. But to organically drive a 13% top-line growth figure to record levels, that means they aren't just passively floating on higher equity markets.
They're actually doing something differently.
Exactly. They are actively capturing new market share, increasing their pricing power, and monetizing their existing client base at a significantly higher rate than their historical average.
And what makes that 13% top-line growth so potent is how it translates as it, moves down the income statement.
Oh, absolutely. The EPS number.
Yes. Earnings per share, or EPS, came in at $2.45. That is up 27% year over year.
That's huge.
Right. I mean, profits are growing more than twice as fast as revenue.
Which naturally points to massive margin expansion.
Exactly. Which we saw, right? Their pre-tax margin hit 40%. But the metric that immediately caught my eye, and the one that I think institutional investors are really going to fixate on, is the return on tangible common equity.
The ROTCE.
Yeah, the ROTCE hit an incredible 31% this quarter.
31% is basically unheard of for a bank.
Right. I mean, in a macroeconomic environment where the yield curve has been incredibly complex.
So complex lately.
And interest rates have fundamentally changed the cost of capital, maintaining a 31% ROTCE is structurally very, very difficult.
Yeah, you look at traditional commercial banks, and they're usually doing backflips in the boardroom if they manage to scrape together like a 15 or 16% return on their tangible equity.
So why is there such a massive gap? I mean, what's the fundamental difference there?
The contrast there is essential to understand because it highlights the fundamental difference in capital requirements.
Okay, how so?
Well, think about a traditional commercial bank. They take in deposits and lend them out as mortgages or corporate debt. So regulators require them to hold a massive cushion of tangible common equity.
Like hard physical shareholder capital.
Exactly. Just to absorb potential loan losses if things go south. And because that equity denominator is so large, generating a high return on that equity is mathematically exhausting.
Right. The math works against them.
But BNY Mellon, on the other hand, operates this asset-light model. They are the ultimate safekeepers.
Right. They hold the assets.
Exactly. When a sovereign wealth fund buys $1 billion of Japanese government bonds, BNY Mellon just holds the assets, clears the trades, handles the tax withholding.
They aren't loaning that money out.
Right. They have virtually zero traditional credit risk, which means their regulatory capital requirements are fundamentally different.
They don't need that massive cushion.
Precisely. Even so, hitting a 31% ROTCE implies that management has optimized their balance sheet to just an extreme degree.
Wow.
Yeah, for every dollar of hard shareholder equity sitting in the firm, they are generating 31 cents of pure profit in a single year.
That is insane. That is the kind of capital efficiency you expect from like a high margin software monopoly, not a custodial pipeline.
Exactly. And that efficiency is exactly what Dermot McDonough, their chief financial officer, was highlighting when he brought up their operating leverage.
Right, the operating leverage. In the transcript, he noted they generated approximately 600 basis points of positive operating leverage.
Which is a lot of corporate jargon.
It is. So translating that jargon, we know that 600 basis points is exactly 6%. But the mechanical reality of how operating leverage functions inside a financial institution, that is where the actual alpha is generated.
So how do you visualize that for the listener?
Well, I always think of operating leverage like a massive manufacturing plant.
Okay, I like that analogy.
Yeah, so if you speed up the assembly line to produce 13% more cars, but through, clever engineering, your electricity bill and labor costs only go up by 7%.
Right.
That delta between revenue growth and expense growth, that's your operating leverage.
That is a perfect mechanical analogy. And in BNY Mellon's case, they grew their revenue by 13%, but their expenses only grew by 7%.
There's that 6% gap.
Exactly. That 6% gap, the 600 basis points, that drops straight to the bottom line as pre-tax profit.
Which is huge, because in the legacy banking sector, the traditional method for growing revenue was basically just aggressively hiring more managing directors, opening new physical offices.
Basically bloating the corporate footprint.
Exactly. It was a linear relationship. You spend $1 to make $1.10.
But positive operating leverage of this magnitude proves that BNY Mellon has broken that linear relationship entirely.
They've uncoupled it.
Right. They've built a scalable machine where the marginal cost of onboarding a new institutional client or processing an extra $100 billion in daily transaction volume is practically zero.
They're expanding the pie while keeping the core cost of baking that pie incredibly rigid.
That's exactly it.
Which naturally invites a healthy dose of skepticism from me.
Oh, of course.
Because if you have been watching the capital markets long enough, you know that anyone can engineer one blowout quarter right.
Oh, easily. A management team can slash the marketing budget to the bone.
Pause all internal investments, get lucky with a volatile quarter and foreign exchange trading.
Right, and just temporarily inflate their margins to look like geniuses.
Exactly. So the critical question we have to ask to determine if this is a durable trend is, how are they actually driving this?
Let's dig into the how.
Well, I noticed their net interest income, or NII, was up 20% year over year to $1.4 billion.
A huge jump.
Yeah, so my immediate question reading that was, how much of that 20% is due to active strategic reinvestment by their Treasury Department versus just passively capturing higher overnight rates from the central bank?
That's a great question.
Yeah.
It's a combination, honestly, but the transcript makes it really clear that active reinvestment is the primary driver right now.
Okay, break down the mechanics of that NII for us.
So net interest income is essentially the spread between what the bank pays institutional clients who park cash with them and the yield the bank earns by investing that cash into incredibly safe liquid assets.
Things like US Treasuries or agency mortgage-backed securities.
Exactly. And over the last 2 years, as older, lower-yielding bonds on their balance sheet have matured, BNY's Treasury team have been methodically taking that return principal and reinvesting it at current, much higher market rates.
Okay, so they're not taking crazy risks.
No, not at all. They aren't taking on duration risk by gambling on 30-year bonds. They are systematically rolling their portfolio into higher yielding short to medium term instruments.
Got it.
That creates this cascading effect where their blended portfolio yield just rises every single quarter, which drives that 20% NII growth, even when the central bank pauses rate hikes.
Okay, so that strategic reinvestment creates this massive, stable floor for their earnings.
Right.
But the other side of the house, the fee revenue derived from their core custodial operations, that's tied directly to the scale of the assets they protect.
And this brings us to a number in the transcript that is just, it has a gravity so immense it almost distorts reality.
It really does. BNY Mellon reported their assets under custody and administration. Their AUCA hit $62.6 trillion.
Trillion. With a T.
Up 12% year over year. To give that number context for you listening, the entire gross domestic product of the United States for an entire year is roughly $28 trillion.
So they are actively administering a pool of global capital that is more than double the size of the entire American economy.
It's hard to even wrap your head around that.
The sheer physics of managing a $62.6 trillion ledger are staggering. And what's crucial for investors to understand here is that custody is an incredibly sticky business.
Very sticky.
Right? When a massive global asset manager or a state pension fund selects a custody bank, the integration process takes years.
Yeah, they have to wire everything together.
Exactly. BNY Mellon has to connect directly into the client's internal trading systems, their risk management dashboards, their accounting software.
So once that plumbing is laid down, you aren't just going to rip it out over a slight fee increase.
Exactly. The switching costs for the client to move to a competitor are astronomically high. So when BNY Mellon reports a 12% increase in those assets, they are securing revenue streams that will likely pay dividends for decades.
And they are monetizing those relationships at a higher rate, too.
Right.
The transcript noted that their average deal size with clients is up by more than 20% year over year.
Which implies they are not just capturing the natural market float as equity prices rise.
Exactly. They're actively cross-selling. But This is exactly where my analytical red flags started going up during the CEO Robin Vince's prepared remarks.
Oh, why is that?
Well, he dedicates a significant portion of his time to talking about artificial intelligence.
Ah, yes. The AI buzzword.
Right. Because right now, every single legacy corporation is engaged in this defensive arms race, spending billions on AI wrappers just to appease analysts and keep up with their peers.
Yeah, it's often just vaporware designed to generate a headline.
Exactly. So my challenge to this narrative when reading the transcript was, is this massive $4 billion technology budget actually willing them the high margin mandates? Or is this just defensive, keeping up with the Joneses spending to make sure they don't lose ground to State Street and JP Morgan?
It's the defining question for any financial institution right now. And analyst Mike Mayo pushed them on exactly this point during the Q&A.
Good. So what was the answer?
The difference between BNY Mellon's transcript and the dozens of other earnings calls we review is the granularity of the receipts they brought.
Okay, what kind of receipts?
They aren't just talking about abstract AI research. They are talking about fundamental workflow alterations. Within that $4 billion annual technology ecosystem, BNY Mellon's engineers are now writing approximately 40% of their software code using AI copilots.
Wait, 40%?
40%.
That is a jaw-dropping metric for a highly regulated bank.
Right.
The software development lifecycle inside a globally systemic financial institution is usually bogged down in months of security reviews, compliance checks, and legacy system integrations.
It's notoriously slow.
So if AI is co-piloting 40% of their code, how does that actually translate into operational efficiency? What does that look like at the ground level?
Well, it looks like the rapid modernization of legacy technical debt.
Okay, unpack that a bit.
Banks like this have back-end systems running on mainframe code that was literally written in the 1980s.
Oh, wow. Yeah, COBOL and stuff like that.
Exactly. Historically, updating that infrastructure required an army of highly paid engineers spending years manually translating old code into modern languages.
Which is incredibly expensive and tedious.
Right. But with AI coding assistance, that translation, the automated testing, and the deployment are all accelerated exponentially.
That makes sense.
But it goes beyond just the engineering teams, too. They've rolled out internal AI agents, this specifically named one called Eliza Planner.
Eliza Planner.
Yeah, and middle and back office employees are actually using it to automate complex corporate actions.
Okay, let's drill into that because corporate actions is one of those opaque banking terms that sounds boring, but is actually super important.
Absolutely.
We're talking about processing stock splits, dividend distributions, mergers, and voting proxies across thousands of different global jurisdictions, right?
Exactly. It requires reconciling massive amounts of unstructured data from different global depositories.
Which usually takes an army of humans.
Right. Historically, that required thousands of human analysts staring at spreadsheets, trying to match trades and resolve settlement fails.
Nightmare material.
Total nightmare. But by deploying AI agents to ingest, structure, and reconcile that data instantaneously, they are fundamentally altering the cost structure of their custody business.
Wow.
And the CEO made a vital philosophical distinction here that I think is really important.
What was it?
He stated that they do not view AI merely as a blunt instrument for efficiency, where the goal is just to fire people. They view it as a capacity creator.
A capacity creator. That distinction between efficiency and capacity creation is incredibly nuanced.
It really is.
Because if I am running a factory and I view automation strictly as efficiency, my goal is to install a robot that does the job of 10 workers, and then I eliminate those 10 salaries from my payroll.
Right. Exactly. It's a finite game of cost cutting.
Right. But capacity creation implies that you deploy the robot to do the manual labor, and then you redirect the human capital toward higher-level revenue-generating tasks.
Yes. You increase the total bandwidth and output of the firm without linearly increasing your headcount expenses.
And in a heavily regulated custody bank, the cultural shift required to get compliance officers, risk managers, and operations staff to actually trust an AI agent to handle multi-million-dollar reconciliations, that is a massive hurdle.
It's a huge hurdle. But the fact that they have achieved this cultural buy-in is totally evident in the financial output.
Where do we see that?
Well, this brings us to the ultimate proof point in the transcript. Despite the 13% increase in revenue and the massive growth in assets under custody, their overall corporate headcount is down 7% year over year.
Oh, wow. Down 7%.
Down 7%.
That right there is the holy grail of operating leverage.
It really is.
I mean, headcount is down 7%, but revenue is up 13%, EPS is up 27%, and the asset base is at a record $62.6 trillion.
The math is beautiful.
When you mathematically distribute a significantly larger pool of revenue across a 7% smaller workforce, your revenue per employee metric goes parabolic.
Absolutely parabolic. And the CFO explicitly noted that this 7% reduction wasn't some draconian top-down mandate where they arbitrarily slashed departments just to hit a quarterly target.
Right. They weren't just mass firing people.
No, it was the natural organic output of the company operating in a fundamentally different, more automated manner. They are reducing the underlying cost to serve a client without degrading the quality of that service.
Which unlocks a massive strategic competitive advantage.
How so?
Well, in the custody banking oligopoly, pricing pressure from clients is notoriously brutal.
Oh, yeah. Asset managers are constantly trying to squeeze their custody banks for lower fees.
Exactly. So BMO Capital actually asked management if BNY Mellon was being forced to share all of these new AI-driven cost savings with their clients by lowering their prices.
That's a really smart question. So how did management frame their pricing power in this new environment?
They acknowledged that the market remains highly competitive, obviously, but they made it clear that because they have driven their internal costs to serve down so aggressively, they have tremendous flexibility now.
Oh, I see.
Yeah, if they need to compete purely on price to win a massive strategic mandate, they have the margin buffer to do so without destroying their profitability.
That's a huge advantage.
But more importantly, they're finding that they don't actually have to compete solely on price anymore.
Because the service is better.
Exactly.
Yeah.
Because they are delivering a technologically superior platform with faster settlement times, real-time data analytics, fewer reconciliation errors, clients are actually willing to pay for that differentiated value.
And the data proves the clients are buying into the broader ecosystem too.
They are. The transcript highlighted that the number of clients buying 3 or more different services across BNY Mellon's various lines of business has increased by more than 60% over the last 3 years.
60%. That is the definition of creating sticky revenue.
Totally. Because if an asset manager only uses you for basic U.S. equity custody, they can easily RFP that business out to a competitor for a 2 basis point discount,
Right, it's just a commodity at that point.
Exactly. But if that same client is using BNY Mellon for global custody, foreign exchange execution, tri-party collateral management, and real-time liquidity analytics,
Then ripping BNY out of their operational flow becomes a multi-year, multi-million-dollar nightmare.
exactly. The integration becomes their strongest defensive moat.
Well, speaking of complex integrations and sticky revenue streams, there was a highly specific, very unique mandate discussed in the transcript that I think serves as a perfect case study for their technological capabilities.
Oh, you're talking about the public sector mandate.
Yes. The CFO highlighted that a significant driver of momentum in their issuer services segment was a new public sector mandate referred to in the call as the Trump accounts.
Okay, now before we break this down, I want to establish a very clear framework for our listeners right now.
Good idea.
We are analyzing this transcript strictly from an impartial, data-driven, and mechanical perspective, exactly as the management team laid it out to Wall Street analysts.
We don't do politics here.
We do not deal in politics on this show. Our only allegiance is to the financial mechanics and the ticker tape. So, stripping away all the political noise, what exactly is the structural nature of this mandate, and why does executing it move the needle for a bank that already manages $62 trillion?
Fair question. So from a purely mechanical and public policy perspective, this is a massive bipartisan federal mandate that officially went live on July 4th.
Okay, recently.
Right. The United States Treasury Department appointed BNY Mellon as the central financial agent to operationalize and support this entire program.
Okay.
The CEO provided some excellent context during the call, actually, noting that the architecture of this initiative was heavily modeled after the Australian superannuation system.
Oh, the Australian superannuation system is fascinating.
It really is.
For those unfamiliar, it is a deeply entrenched, mandatory national retirement savings system designed to ensure widespread structural participation in the capital markets.
Right.
Employers are essentially required to contribute a percentage of an employee's earnings into a superannuation fund. And over decades, this has created one of the largest, most robust pools of managed capital in the world relative to their population size.
Exactly. The Australian model fundamentally altered their national savings rate and created a massive ecosystem for asset managers and custody banks.
Okay, so this U.S. policy is similar.
Right. The new U.S. policy aims for a similar outcome, driving broader individual engagement and wealth building within the capitalist system by providing structured, long-term market participation.
But the financial plumbing required to take a federal policy of that magnitude and actually operationalize it for millions of individual accounts is just mind-boggling.
Oh, it's a monumental task.
You can't just flip a switch, You need an institution capable of handling the immense administrative burden, the continuous record-keeping, the cybersecurity protocols.
And the sheer transaction volume without the system buckling.
Exactly.
Yeah.
Which is why the Treasury selected BNY Mellon.
Right. To execute this, the bank had to pull together disparate capabilities from across their entire enterprise.
Like what?
Like integrating their corporate trust division, their custody platforms, and their administrative technology, just to build a bespoke, unified infrastructure capable of handling federal scale. And the fact that they successfully launched the program on July 4th without any systemic hiccups, that's a massive validation of all those technology investments we were just talking about.
And from a revenue perspective, how does the CFO model the financial impact of this mandate going forward? I mean, is it a massive growth engine?
So Dermot McDonough was very transparent about the revenue curve here. He explicitly stated that while they do not expect the revenue from this specific program to continuously compound and grow exponentially year after year.
Because it'll eventually plateau as the initial rollout stabilizes.
Exactly.
Yeah.
But it represents a highly durable, recurring revenue stream. It is a long-term contract locked directly into their issuer services segment, which basically provides a very reliable baseline of fee income for the foreseeable future.
And beyond the immediate fee income, the strategic value of successfully launching a federal mandate of this complexity, it basically acts as a global billboard for the bank.
That's a great point.
Yeah, the CEO hinted that other sovereign governments and public sector entities around the world are carefully watching how this rollout performs.
Because everyone wants a system like this.
Right. When you can prove to a foreign central bank or a sovereign wealth fund that you have the technological agility to take an unprecedented, massive-scale public policy initiative and seamlessly operationalize it on a national level.
You instantly become the front runner for every major global infrastructure contract.
Exactly. It is the ultimate proof of concept for their integrated commercial platform.
It absolutely is. And that brings us to a critical pivot point in our analysis today.
Okay, where are we pivoting?
Well, we have exhaustively broken down the rearview mirror, right?
True.
Q2 was undeniably a powerhouse quarter. Record top-line revenue, explosive EPS growth, undeniable operating leverage driven by AI adoption, and the successful execution of landmark federal mandates.
It's an A-plus report card.
But as any seasoned investor knows, the stock market does not pay you for what a company did yesterday.
Exactly. The market is a forward-looking discounting mechanism. It only cares about the future trajectory of cash flows.
Which means we need to look at what management is telling us about the road ahead. We need to examine their forward projections, understand how much of this current momentum is already baked into their guidance, and, analyze the specific macroeconomic assumptions they're using to build those models.
So let's dissect the management guidance for the remainder of 2026. What exactly are they projecting?
This is where the transcript transitions from a report card into basically a declaration of structural confidence.
Oh, I like that phrasing.
Management is seeing such strong underlying momentum in their core businesses that they significantly raised their financial outlook for the full year.
Oh, they raised it.
Yeah, initially their projections were somewhat conservative, which is typical for a legacy bank. But now they have shifted to a highly aggressive stance.
What were the numbers?
They officially upgraded their guidance, expecting net interest income to be up between 12% and 13% for the entire 2026 fiscal year.
Wow. And on the efficiency side, are they projecting that the 600 basis points of operating leverage they achieved in Q2 will actually sustain itself?
They are managing expectations slightly there, but it is still an incredibly bullish forecast. They are guiding for 400 basis points of positive operating leverage for the full year of 2026.
Okay, so mechanically, that means over the entire 12-month cycle, they expect their cumulative revenue growth to outpace their cumulative expense growth by a full 4%.
Correct.
In a business that generates nearly $23 billion in annual revenue, expanding the margin by 4% across the entire enterprise, that translates into massive compounding bottom-line cash flow for shareholders.
Exactly. But the most revealing moment regarding their future trajectory didn't actually come from the raw numbers.
Really? Where did it come from?
It came during a specific exchange in the Q&A session. An analyst asked the CFO if, given the massive success of the transformation so far, we should expect a natural plateau or a deceleration in growth as the initial cost-cutting measures are exhausted.
Basically asking, are you running out of steam?
Right. And Dermot McDonough responded with this brilliant, highly specific analogy. He said, and I quote, "We don't expect it to be a lull on day 3 of the cricket match."
Okay, that is a phenomenal piece of corporate psychology right there.
That's it.
It perfectly illustrates the mindset of this executive team. So for those listening who aren't familiar with the rhythm of traditional test cricket,
Which is probably most of our American audience.
fair point. A single match is an exhausting war of attrition played over 5 consecutive days. It is physically and mentally grueling.
Right.
By the time you reach day 3, it is universally known as moving day. The initial adrenaline of day 1 has completely evaporated. The pitch, the actual grass they are playing on, is starting to crack and deteriorate under the wear and tear.
The players are fatigued.
Exactly. Historically, human nature dictates that day 3 is when you expect a lull in the action. Teams get defensive, they get tired, they play cautiously, and they basically just try to survive until the next session.
It is the perfect metaphor for corporate transformation fatigue.
Totally.
Most management teams will initiate a massive overhaul, push hard for 2 years, achieve a great quarter like this Q2, and then they hit their own day 3.
They get tired, they pat themselves on the back, they pay out their bonuses, and they shift into a defensive coasting mentality.
Exactly. So by explicitly telling Wall Street that there will be no lull on day 3, the CFO is signaling that they are completely immune to transformation fatigue.
They view this record-breaking quarter not as a finish line, but as the new baseline. They are stepping on the gas.
And the CEO echoed that exact sentiment by talking about aggressively targeting the white space, within their business model.
Now, wait, when a massive legacy corporation talks about chasing white space, that often terrifies investors.
Oh, absolutely.
Because it usually implies they're going to waste billions of dollars venturing into completely uncharted, high-risk territories where they have absolutely no expertise, like opening a consumer retail branch network or launching an unproven proprietary trading desk.
Yeah, diversification. But BNY Mellon's definition of white space is highly calculated and deeply synergistic.
Okay, so what is their definition?
It is entirely focused on leveraging their existing competitive moats. They define white space across 3 specific vectors.
Okay, what's the first one?
First, as we discussed, is cross-selling into their existing $62 trillion ecosystem. If a sovereign wealth fund is utilizing 2 products, the white space is methodically integrating them into 4 or 5 products.
Makes sense. What's the second vector?
Second is targeted geographical expansion, winning new, complex mandates in emerging capital markets in the Middle East or Asia, where institutional asset pools are growing rapidly.
Okay, and the third vector?
The third is rapid niche product innovation. The transcript highlighted new proprietary platforms they are rolling out, specifically mentioning tools like Collateral One and Borrow Plus.
And these aren't just speculative consumer apps, right?
No, not at all. They are highly specialized institutional-grade solutions designed to solve very specific friction points for asset managers in the collateral management and securities lending markets.
Okay, so by identifying a granular problem in the daily workflow of, say, a hedge fund and building a digital solution for it, they immediately generate a new high-margin fee stream that integrates perfectly into their core custody platform.
That disciplined approach to growth is exactly why the market is reacting so favorably right now.
But, and this is a big, but any thorough, impartial analysis must acknowledge the risks, right?
Always.
Management was very deliberate in providing a crucial reality check regarding the immediate short-term headwinds. And we need to unpack those caveats so you, the listener, aren't blindsided by the next quarterly report.
Yeah, the mechanics of Q3 seasonality in the capital markets are just completely unavoidable no matter how efficient your AI is.
It's just the calendar. Exactly. Q3 covers July, August, and September. Across the global financial system, this is historically the most dormant period of the year.
Senior deal makers and traders are all taking their summer vacations.
Right. Entire financial districts in Europe practically shut down for the entire month of August. As a result, global trading volumes plummet, initial public offerings are delayed until the fall, and massive mergers and acquisitions take a pause.
And because BNY Mellon's fee revenue is directly tied to the velocity and volume of global financial transactions, their core revenue engine naturally idles down during these months.
It's just a structural reality.
And the CFO actually added another layer to that seasonal warning. He noted that last year's Q3 experienced several weird, idiosyncratic market events that caused abnormal spikes in transaction volume.
Which effectively masked the usual summer slowdown last year.
Exactly. So when analysts run their year-over-year comparative models next quarter, stacking a normalized, sleepy Q3 of 2026 against an artificially hyperactive Q3 of 2025, the growth percentages are going to look mathematically depressed.
It is a really tough comparative hurdle.
It is.
So what was the other major caveat they baked into their forward guidance?
It revolves around their macroeconomic assumptions, specifically regarding central bank interest rates. They are building their entire forecast on a completely flat rate environment.
Meaning?
They are mechanically modeling that global interest rates will remain exactly where they were frozen on June 30th. All the way through the end of the year.
Which is an incredibly conservative posture.
Very conservative.
I mean, if you look at the current macroeconomic consensus and the federal funds futures market, traders are actively pricing in potential rate adjustments, perhaps a rate hike in the U.S. depending on inflation stickiness, and potentially divergent rate moves by the European Central Bank and the Bank of England.
True. But BNY Mellon's Treasury team absolutely refuses to build those speculative adjustments into their guidance.
That is a masterclass in disciplined risk management.
It really is.
By assuming a flat rate environment, they're deliberately narrowing the cone of outcomes. They're essentially telling the market, we are going to deliver this 12 to 13% NII growth based solely on our own internal execution and active reinvestment strategy.
Right. If the central bank raises rates and gives us an exogenous tailwind, that is purely upside surprise. But we will not promise you revenue based on a macroeconomic gamble that might never materialize.
That builds immense credibility with institutional shareholders.
It really does. So if we synthesize this entire guidance package for the listener, The day-to-day optics in Q3 might look slightly cloudy due to European holidays and tough year-over-year comparables.
So do not panic if the sequential momentum appears to pause.
Exactly. Because when you zoom out to the macro trajectory, the relentless 12 to 13% growth in NII, the commitment to 400 basis points of operating leverage, and the structural refusal to succumb to transformation fatigue, the underlying business model is fundamentally accelerating.
Which brings us directly to the most critical juncture of our analysis, the bottom line.
So what for the listener?
Exactly. This is where the theoretical mechanics of corporate finance meet the practical reality of retail investing. It's intellectually fascinating that BNY Mellon is writing code with artificial intelligence, crushing their operating margins, and securing massive federal mandates.
Sure.
But if I'm an individual investor holding shares of this company in my brokerage account, how does any of this institutional success actually accrue to my benefit?
A very fair question.
Right. Is this cash just getting trapped inside a massive corporate bureaucracy, or is management aggressively finding ways to put it directly into my pocket?
Well, this is where the investment thesis for BNY Mellon transitions from a story about operational efficiency into a story about relentless, massive capital return.
Oh, they are returning capital.
Because the reality is, they are throwing cash back at their shareholders with unprecedented aggression.
Yeah.
In the second quarter alone, a single 90-day period, they returned $1.5 billion of capital to their common shareholders.
Wow, $1.5 billion in 3 months.
Right. And when you look at the first half of the year in totality, they have returned $2.8 billion. That translates to an 87% total payout ratio year to date.
87%. To fully grasp the magnitude of that number, we have to look at the mechanics of capital distribution,
Let's break it down.
A payout ratio measures exactly what percentage of a company's pure net income is being distributed to the owners, rather than being hoarded on the balance sheet or squandered on vanity projects. BNY Mellon is taking 87 cents of every single dollar of profit they generate and handing it directly back to their investors.
And they are executing that return through a dual-pronged strategy.
What's the first prong?
First, they are heavily utilizing share repurchases. By buying back their own stock on the open market and retiring those shares, they shrink the total share count.
Which creates a really powerful financial flywheel.
Exactly. Every remaining share in your portfolio instantly represents a larger fractional ownership of the company.
And it artificially boosts future earnings per share calculations because the profit is divided by a smaller denominator.
Spot on. Second, they are aggressively hiking their direct cash distributions. The transcript highlighted that they raised their quarterly common stock dividend by a massive 19%, bringing it to 63 cents per share.
A 19% raise in your passive dividend income is phenomenal, especially coming from a historically conservative management team.
It's a huge signal.
A dividend hike of that magnitude is not a decision made lightly by a bank's board of directors. It is a definitive, permanent signal to the market that they have absolute confidence in the long-term durability and predictability of their future cash flows.
Right.
They would never authorize a 19% increase if they thought their AI efficiencies were just a temporary mirage.
No, of course not. And it highlights the ultimate luxury of their capital-light, custody-focused business model. Because they do not have a massive book of commercial real estate loans that might default, they don't have to trap billions of dollars in loan loss reserves.
They have zero non-performing assets dragging down their balance sheet in that regard.
Exactly. Their primary constraint is just regulatory capital related to operational risk. And once they satisfy that, the excess cash generation is entirely free to be distributed.
So, distilling this entire deep dive into an actionable, opinionated thesis for you, the retail investor, my stance is unequivocally bullish.
I agree completely.
If you look at the fundamental architecture of the business, 75% of their fee revenue is recurring. This is not a highly cyclical, volatile investment bank that relies on the chaotic froth of M&A deal flow or the speculative gambles of a proprietary trading desk that can blow up overnight.
Right.
They have posted 14 consecutive quarters of year-over-year sales growth. That is 3.5 years of compounding, relentless execution through varying macroeconomic cycles.
I completely agree with that assessment. They have successfully proven that they can modernize their legacy infrastructure, deploy artificial intelligence to meaningfully reduce their headcount and cost to serve, and drastically expand their operating margins, all while managing $62 trillion in assets without a single systemic failure.
It is the perfect synthesis of centuries-old institutional trust paired with cutting-edge technological efficiency.
It really is.
So if you are an existing investor holding this stock, this transcript is a massive validation of your thesis. The momentum is not just intact, it is structurally accelerating. It is a phenomenal asset to hold.
Absolutely a hold.
And if you are a retail investor looking for a durable anchor position in the financial sector of your portfolio, something that provides incredible downside protection through massive recurring fee streams, but still possesses a legitimate AI-driven catalyst for margin expansion and multiple re-rating BNY Mellon demands your immediate attention.
They really do.
They are proving, beyond a shadow of a doubt, that a 240-year-old institution can absolutely master the modern digital economy.
But wait, before we close the book on this transcript, there is one final, highly provocative detail tucked away in the middle of the call that we absolutely must address.
Oh, really?
Yeah, because it has the potential to fundamentally rewrite our understanding of where the entire global financial system is headed over the next 20 years.
Oh, I know what you're talking about. You are referring to the commentary regarding their digital asset strategy and the Circle partnership.
Exactly. The transcript explicitly highlighted BNY Mellon's expanding relationship with Circle.
So for context, Circle is the primary architect and issuer of USDC, which is a massive globally systemic stablecoin, a cryptocurrency token that is pegged one-to-one with the US dollar.
Right. Now, BNY Mellon has already been acting as the primary custodian for the tens of billions of dollars in traditional cash reserves that back the USDC token.
Right.
But the transcript revealed that they are taking the integration a massive step further. They are integrating the actual mint and burn capabilities of the stablecoin directly into their single operating platform.
Wait, so mechanically, that means BNY Mellon is actively building the direct plumbing between traditional fiat currency and the decentralized blockchain.
Yes.
They are allowing institutional clients to seamlessly move capital from a traditional bank account, tokenize it into USDC on the blockchain, and deploy it in the digital asset ecosystem seamlessly and instantly.
And this capability forces us to confront a massive philosophical question.
What's that?
For the last 10 to 15 years, the dominant, almost unquestioned narrative in the financial media has been that nimble, rebellious tech startups and decentralized autonomous organizations were going to completely overthrow and disintermediate the legacy banking system.
Right. We were always told that software is eating Wall Street and that institutions like BNY Mellon were destined to become obsolete dinosaurs, just disrupted into extinction by the blockchain.
But the reality of global finance is dictated by regulatory compliance, institutional grade security, and immense capital scale. A decentralized startup cannot custody $1 trillion for a sovereign wealth fund.
No, they can't.
But BNY Mellon already holds $62.6 trillion of the world's traditional assets. They are already the trusted, regulated gatekeepers for central banks and institutional giants. They have the impenetrable security protocols, the regulatory charters, and the global relationships.
So what's the takeaway here for the listener?
I want to leave you with this final provocative thought to mull over as you analyze your own portfolio. What if the entire disruption narrative is completely backwards?
Interesting.
What if the ultimate long-term winners of the crypto, tokenization, and digital asset revolution are not the chaotic, unregulated startups in Silicon Valley? What if the legacy infrastructure banks, the institutions founded in the 1700s, operating quietly in the background, simply adapt, build the necessary bridges to the blockchain, and leverage their massive existing scale to become the undisputed monopolistic gatekeepers of the future digital financial system?
Wow. It is a staggering proposition. It basically suggests that the ancient oak tree isn't just growing a few new leaves, it is methodically expanding its root system to silently absorb the entire forest. And it completely alters how you value the long-term terminal value of these legacy institutions.
And it is exactly why reading the primary source material, getting past the headlines, and diving into the granular mechanics of earnings transcripts is so incredibly vital for your success as an investor.
You do not find these massive paradigm shifts neatly packaged in mainstream financial news segments.
No, you find them buried in the CFO's off-the-cuff remarks about the third day of a cricket match, or in a brief sentence about stablecoin minting integration.
Absolutely. The alpha is always hidden in the mechanics. Well, that brings us to the end of today's deep dive. We have unpacked the revenue, dismantled the operating leverage, analyzed the AI integration, and laid out the long-term digital trajectory.
It's been a ride.
Thank you, as always, to you, the listener, for spending this time with us, for engaging deeply with the data, and for having the intellectual curiosity to understand the underlying plumbing of the market. Keep questioning the consensus narratives, keep looking past the corporate jargon, and most importantly, keep asking the hard, mechanical questions about every single asset in your portfolio. Until next time, stay curious.